Good evening, everyone. This is Henry Gamble with SimplerOptions.com, and in today's free video I wanted to talk about some of the nuances that you may run into while trading monthly expiration. A couple of good examples of these comes in Facebook and then another in Goldman Sachs. So if we start off looking at Facebook, the main thing that I would try to point out is that this is not entirely a setup based off of just the charts. It's based a little bit more in regards to your open interest and where we look to see underlyings consolidate or trade close to into expiration. So if we're scanning down the list of open interest here, you'll see that the call side sticks out like a sore thumb. Okay, as you continue scrolling down, there are other strikes that have large open interest, but none that really compare to that 45,000. As you come down and look at this on the put side, okay, there's 12,000 as the standout on the put side. The 95s are pretty decent here too with 8,000. The way I try to think of it is think of each side independently to say, okay, that's essentially telling me that whoever has been selling these has a vested interest in the 94 put expiring worthless and the 95 call expiring worthless. You might be getting into a little bit more of a pinning situation since there's decent OI on the 95 as well, but you're really just trying to take advantage of range-bound trade in there and making sure you have positive theta. So the way that we've positioned for this, we've been scaling into these positions throughout the day, and I'll be willing to do more of it tomorrow if we get any big gap, but it's just selling puts on weakness, selling calls on strength, and then another thing I did was sell a short straddle right when we were trading at 95. I like doing that when the stock was trading at exactly 95 because that's when you're going to get the most balanced exposure from the short put and the short call. Obviously that's a very nice positive theta position, and as long as you don't get carried away with your position size, I think these are great types of trades to look at for monthly expiration. Now if we take Goldman Sachs and do something very similar, you notice that this one is not quite as much of a standout, but you do have a decent chunk of open interest here on the $200 put side. If you want to keep things simple, all you do is just keep the short puts, and we spoke about selling those on weakness this morning. You know, when the whole world was coming to an end and the markets were selling off hard, we just knew that we had support down here at 198.56, and we knew that with that high open interest, someone has a vested interest in those expiring worthless. So we sold a chunk of those. If you want to keep things simple, just hold on to the short puts, and ideally they will expire worthless. If tomorrow the market is really starting to see a little bit more weakness, etc., I'm going to look to come in here and sell the 200-205 call spread. This will neutralize my delta. This will add some more positive theta, and it will just give me a little more cushion to hold on to the trade into Friday. It's also a place where if you really wanted to do it, you could do the exact same thing by selling the straddle when the stock trades around 200. There is an infinite amount of risk with this, so you do have to be careful, but you're looking at about maybe a $2.50 credit tomorrow, and if you can get that, I think you could probably make a buck into Friday. So I hope that helps. You guys find that analysis and some of those tips into expiration useful, and I will talk to you at the next free video.